Welcome back to the deep dive. Today, we're really getting into something fundamental,
Yeah.
cash dividends.
Yeah, super important stuff.
We're going to look at what they are, why companies might pay them, or maybe why they don't, and, the accounting side of things. But before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures.
That's right.
All the content, examples, explanations, it all comes from the great accounting resources over at farhatlectures.com. So if you're an accounting student studying for the CPA exam or even a professional, you should definitely check out the website. They've got extra practice questions, video lectures, lots of support to really nail down topics like today's.
Absolutely. Professor Farhat's material is top-notch.
Big thanks to Professor Farhat for providing it. Okay, so let's unpack this then. Because really, understanding dividends, it's kind of key to understanding how companies tick, how they manage their profits, right?
It really is. And what's fascinating, I think, is how this seemingly simple idea, a dividend, connects straight to a company's long-term health and, crucially, to investor expectations.
Yeah, totally. So let's start at the beginning. What is a dividend, really? The big idea.
Okay, simplest terms, a dividend is just a company sharing its profit with its owners,
Yeah.
the shareholders.
Right.
Think about it. Company makes money, revenues come in, they pay their expenses. What's left over?
Net income,
Yeah,
profits.
exactly. Profit. Now, that profit, it doesn't just vanish. The company has a choice, basically. Keep it or hand some of it out.
And when they keep it, that's where retained earnings comes in, isn't it? It's like the company's piggy bank for all the profits it hasn't paid out over the years.
Precisely. That's the perfect analogy. All that net income builds up in an equity account called retained earnings. It's literally the profits the company has, well, retained.
Okay.
And here's the critical point for today. A true dividend, the kind we're mostly talking about, has to come out of that specific pool, out of retained earnings.
Okay. So what if a company gives out money, but it doesn't come from retained earnings? Is that still a dividend?
Well, not in the same way. You sometimes hear about things called liquidating dividends. That's different. That's more like returning the original investment money back to shareholders, not distributing profits.
Okay, different category.
Yeah, very different for tax purposes and accounting. But for this deep dive, when we say dividend, we mean the cash coming straight from that retained earnings account, the profits.
Got it. Okay, let's zoom in on cash dividends then. They're the most common, right? So what happens like on the company's books when they pay out cash?
Right. When cash goes out the door as a dividend, two main things happen on the balance sheet. First, assets go down specifically. The cash account shrinks.
This cash.
And second, equity also goes down because you're reducing those retained earnings we just talked about. So less assets, less equity.
It's interesting you mentioned the source material talks about stock dividends later on, and those apparently don't reduce assets and equity in the same way.
Correct. Stock dividends are a whole different animal. They don't involve cash leaving the company.
Yeah.
But cash dividends. Direct hit to cash and equity.
Okay, so if dividends are about sharing profits, and who doesn't like profit, why don't all companies pay them? Like, wouldn't an owner always want their share?
That's a really core question. And it gets into company strategy. Not all companies pay dividends, and there's some really solid reasons why.
Like what?
Well, one big one can be restrictions from creditors, lenders.
The bank.
Exactly. If a company borrowed money, the loan agreement might say something like, hey, you need to keep your retained earnings above, say, $500,000. That protects the lender.
So the lender basically puts a limit on payouts.
Right. They want to make sure the company stays healthy enough to pay back the loan, so that can directly block dividends. But honestly, probably the biggest reason, the most common one, is reinvestment. Internal financing for growth.
Okay, explain that.
Think about, like, Google or Amazon in their early days, or even now to some extent. They were making tons of money, right? Billions. But instead of sending that cash out to shareholders, they plowed it back into the business. New projects, research, expansion. Why? Because they believed those internal projects would generate a much higher return than investors could get elsewhere.
So it's like the company saying, give us your dollar, we can turn it into $2 faster than you can if we just give it back to you now.
Precisely. It's a strategic bet. Is the money better off reinvested for potentially huge future growth or paid out now?
Yeah.
For growth companies, reinvestment often wins.
That makes a lot of sense.
And there's a third reason, too. Sometimes companies just want a safety net, a nice big cash cushion.
For rainy days.
Yeah, exactly. For economic downturns, unexpected problems, whatever might come up.
Yeah.
Having that buffer means they can weather storms without, having to panic or borrow heavily.
Right.
Stability.
You see that a lot with like tech companies, pharmaceutical companies maybe,
Yeah.
always needing cash for the next big R&D push or acquisition.
Definitely. Those industries often prioritize that internal investment and cash cushion.
Okay, this next part I find really fascinating. Once a company starts paying dividends, it's not just a payment anymore, is it? It becomes an expectation, like a promise.
Oh, absolutely. It gets baked in, as they say. Investors start counting on it. Now, it's not usually a legal requirement to keep paying, but if a company that has a history of paying dividends suddenly stops or cuts it significantly, whoosh,
Yeah.
the stock price is almost guaranteed to take a serious hit.
Yeah, investors hate that surprise.
They rely on that income stream. Cutting it feels like breaking trust, even if it's not technically illegal.
And we've seen real-world examples of this, haven't we? I remember BP, British Petroleum, after the big oil spill in the Gulf.
Well, right. They had to suspend their dividend, needed the cash for the massive cleanup costs.
And their stock got hammered. Same with GE, General Electric, during the financial crisis, wasn't it? They had huge losses from their lending side.
Yep, suspended the dividend. Same result. Stock price suffered badly.
Well,
It really shows you, companies don't take the decision to start paying dividends lightly. They plan very carefully, very conservatively. They usually assume, if we start this, we need to be pretty darn sure we can keep doing it. Forever.
that's a big commitment.
It is. And even companies that don't pay dividends, they still need to communicate clearly with investors about their plans, why they're holding onto the cash, what the future might look like. That info matters a lot.
Well, let's make this concrete. Microsoft is a great example here, right? They went public, when was it? 1986?
That's right, 86.
But they didn't pay their first dividend until February 17th, 2003. That's what, 17 years?
Almost 2 decades. It's a perfect case study in long-term thinking. And that first dividend, just 8 cents per share, tiny.
8 pennies.
Yeah. Now, they did double it briefly, and there was that one-off special dividend in 2004, a big $3 one, actually. That was mostly due to huge pressure from investors sitting on mountains of Microsoft cash.
Right. Investors wanted some of that hoard.
They did. But after that special payment, they went back to 8 cents, and they just steadily increased it year after year. It went to 9 cents in 2006, 10 cents in 2007, then 13 cents, 16 cents by 2011.
Keep going.
28 cents by 2014, 39 cents in 2016, and by 2023, it had reached 62 cents per share.
So from 8 cents in 2003 to 62 cents 20 years later, that really drives home the point, doesn't it?
It absolutely does. They planned that growth. They started small, made sure it was sustainable, and then let it grow alongside the company's overall success. It shows that long-term dividend strategy in action.
It really shows that patient reinvestment first can lead to really strong, reliable dividends later. Okay, let's switch gears slightly. Let's get into the nuts and bolts. The accounting side. We said a dividend reduces equity and assets. But when does it officially become an obligation? When does the company actually owe that money?
Great question. It's not an obligation just because the company has profits. It only becomes a real liability, something the company legally owes, when the board of directors declares it.
The board. They're elected by the shareholders, manage the company day to day, essentially.
Correct. They have the authority.
Yeah.
Once the board votes and declares a dividend, boom, it's official. It's a liability.
And the source material mentions there are 3 key dates involved in this whole process.
Yep, 3 important dates to track. The first one is the date of declaration.
Okay, declaration.
This is the day the board makes the formal announcement. Let's say they declare a total dividend of, I don't know, $1 million.
Right.
On that day, the accounting entry happens. The company reduces its retained earnings, because that's where the dividend is coming from, and it creates a liability called dividend payable. So equity goes down, liabilities go up.
Okay, so the debt is officially recorded. What's next?
Next is the date of record. Now, interestingly, there's no accounting entry on this date.
Journal entry. Huh. So what's it for?
Its only job is to determine who gets the dividend. The company basically takes a snapshot of its shareholder list on this specific date. If you own the stock on the date of record, you get the check.
Ah, okay. So if they declare it December 23rd, the record date might be, say, January 5th. You need to be holding the stock on Jan 5th.
Exactly. If you buy it on Jan 6th, you missed out on that specific dividend payment.
Got it. Declaration, record. What's the third date?
The date of payment, this is the day the cash actually goes out.
Payday.
Payday for the shareholders, yeah. So maybe using our example, that's January 15th. On this date, the company makes another accounting entry. They decrease the dividend payable liability because they're paying off that debt, and they decrease their cash asset account.
So the liability disappears and the cash disappears.
Precisely. Liability goes down, asset goes down.
Okay, so let's circle back. We went through declaration, record, payment. When the dust settles after all that, what's the final impact?
The final impact is exactly what we said near the beginning. The net effect of a cash dividend is a reduction in the company's assets, specifically cash, and a reduction in its equity, specifically retained earnings. The dates and entries just map out how that happens.
Perfect. So we've really unpacked cash dividends today, haven't we? From where the money originates, those retained earnings, to the big strategic reasons why companies pay them, or maybe choose not to.
Right, the reinvestment versus payout decision.
Yeah, and even the nitty-gritty accounting steps with those 3 key dates, it really does give you a different way to look at a company's finances.
It really does. And I think it raises a key question for anyone listening, whether you're an investor or just curious about how business works. Looking at a company's dividend policy, do they pay one? Is it growing? Is it stable? Did they cut it?
Yeah.
That gives you a powerful lens.
A lens into what?
Into their strategy.
Yeah.
Are they all about growth right now? Are they focused on stability and returning cash? Are they trying to balance both? It encourages you to think more critically about what the company is signaling with its cash decisions.
That's a great point. So next time you see news about a company's dividend, you won't just see a number. You'll have a much better sense of the story, the strategy, the commitment behind that decision. And maybe think about what other stories can you uncover by looking closely at how companies distribute or don't distribute their earnings.
Yeah.
Something to chew on. And of course, if you do want to dive even deeper, especially into the accounting side, or maybe you're gearing up for the CPA exam.
Definitely check out Farhat lectures.
Exactly. FarhatLectures.com. Great place for more practice, more videos, really solid support on all these topics.